If you're to open up Robinhood right now, you could bet on who wins the next presidential election right into your retirement savings account. I'm not exaggerating. The same app where millions of people keep their investment portfolios now lets you trade contracts on everything from presidential elections to Fed interest rate decisions. Nobody can agree on what this actually is. Is it investing? Is it gambling? Are we kind of entering that space where it's becoming a bit of both now? The line between the stock portfolios and the betting app is slowly disappearing over time. We're going to break down what these prediction markets are, how they differ from buying stocks and options, and what they have in common with gambling. But before we get started, just a quick disclaimer. None of what I'm going to be going over today is any sort of financial advice, and I am not some sort of financial advisor. This is just for research and entertainment purposes. I guess the first thing we should probably ask ourselves is what actually is a prediction market? You know how stocks let you buy pieces of a company? A prediction market lets you buy contracts on whether something will or will not happen. Let's say there's an election coming up. You buy a contract that pays $1 if candidate A wins. You think they'll probably win, so you pay 65 cents. If they win, you make 35 cents, and if they lose, you make nothing. These prices move based on what everyone else is thinking. A good debate performance can jump a price up 75 cents. When bad news hits, the price can drop 50 cents. These prediction contracts can exist for virtually anything. They exist for things like earning reports for certain corporations, Bitcoin price projections, weather events, anything that can either happen or not happen. These prediction markets aren't something new, however. Since the 80s, many universities have been running these prediction markets for their own research. For example, the Iowa electronic markets have been predicting elections for decades, often more accurately than any poll you'll ever see. What's changed now, however, is that companies now realize that real people will pay real money for this type of thing. Now these companies like Kalshi, Polymarket, and others have started offering these commercial contracts for this. And very recently, Robinhood, with their 24 million users, have now added prediction markets to their app. Suddenly, the same app where you bought your first Apple stock is asking if you want to make a bet on the Super Bowl. So that just kind of boils down to that question, doesn't it? Is this just another financial product? Or is this something else entirely that we need to start looking into? People very often lump stocks, gambling, and option contracts into the same kind of bucket, but they are all fundamentally very different for very different reasons. When you buy a stock, an ETF, or an index fund, you own portions of a real company. You buy $1,000 on Microsoft, you now own a part of their software, cloud service, and annual profits. Theoretically, you can hold stocks forever if the business is strong enough. These companies generate value. They make products, generate profits, and they often grow over time. Options are a bet on if a stock will hit a certain price by a certain date. Let's say Apple is currently at $150 a share. You can buy a call option to purchase that same share at $160 within 30 days. If Apple then hits $170, you profit. If it stays flat, the option expires worthless. Options can have legitimate uses, however, like using it as a hedge or insurance for a position that you're currently holding. But most retail users of these options are speculating, to be fair. And most of these options are worthless because you're fighting against both timing the market and also predicting the direction of the market as well. Gambling are just pure bets. Sports betting, right? Put money on a game. If your team wins, you get money. If your team loses, you end up with nothing. You're not owning anything. You're making a prediction on an event and you're putting money on it. Stocks allow you to own something real. Options are temporary contracts. And prediction markets are bets on outcomes. Stocks can last forever. Options can expire. And prediction markets are resolved once the event is over. Stocks more often than not fund businesses that build things that create value. Gambling and prediction markets are zero sum. Somebody has to win and someone has to lose. With stocks, you can still be wrong in the short term, but win in the long term if the business is strong enough. With options and prediction markets, being right too early still means that you can lose out on everything. Now let's talk about why some people think that these prediction markets are valuable. The argument is very simple. When people have real money on the line, they tend to think a bit harder. Instead of repeating headlines or gut feelings, the psychology behind it is that participants research, analyze, and trade based off of information. When thousands upon thousands and even millions in some cases do this at once, The market price becomes a probability estimate. We have several decades of research to support this even. These prediction markets have often outperformed expert forecasts and traditional polling. These prediction forecasts can even serve legitimate economic purposes as well. A farmer could hedge against drought. A company could hedge against regulatory changes. Some economists love these prediction markets because they aggregate information very quickly. If a market says there's a 65% chance of something happening, that number reflects what thousands of people collectively believe. This is the wisdom of crowds idea. Individuals may be wrong, but large groups surprisingly produce accurate forecasts. Sometimes it genuinely works out. Prediction markets react quickly to breaking news. Very often they'll catch these shifts before traditional polling does. So the case that's being made is for better forecasting, faster information, and potentially useful hedging tools. But this line of thinking can be extremely dangerous as well. Just because something produces information doesn't mean it's not gambling. Sports betting markets also create probability estimates. The odds on a sports book reflect crowd expectations too, and very often they can be very wrong. And nobody calls that investing. And as far as hedging goes, most people on these betting markets aren't farmers hedging against drought. They're speculating because they think that it's exciting and that they can make some money off of it. These prediction markets are only as smart as the people that are using them. If most users are casual traders, then you're just aggregating casual opinions. It's also important to note that problem gambling is not a niche issue either. Many millions of people across the world struggle with it. And unlike many other addictions, gambling addiction can stay hidden for years without you even knowing about it. The psychology behind gambling is very powerful. That dopamine rush that you get keeps people coming back. You almost called the election correctly. Your option almost expired within the money. You were so close. That almost feeling is part of what keeps people hooked. Many years ago, gambling required a lot more effort because you had to physically go somewhere to do it. But now you can place these bets instantly on your couch at 2 a.m. When you mix gambling with investing, you're now blurring the psychological line that used to exist between them. Let's say one day you open up your Robinhood account. You want to buy some index funds, maybe some individual stocks if you're feeling frisky. Let's say a new investor opens up their Robinhood account for the first time thinking, I'm going to invest for the future. They buy some index funds and maybe some individual stocks. They're building wealth. They're being responsible. Then right there in the same app, they see these prediction market contracts saying, hey, come make some quick money on these election predictions. And it's presented the exact same way. Same interface, same simple buy button. Over time, it all starts to feel the same. Buying Apple stock, buying a call option, buying a contract whether it's going to rain tomorrow or not. They all become just buttons to press and numbers that can go up and down. Studies show that gamblers lose about $50,000 to $90,000 on average before they seek help. When we're talking about whether these prediction markets should be on these investing platforms or not, we're not just talking about semantics or regulatory categories. We're talking about whether these platforms are willing to expose a percentage of their users to something that could potentially ruin them forever in the long run. This is why, when Robinhood announced that they're going to be adding these prediction markets to their platforms, it was a huge deal. It's not just a niche crypto platform. You're going to be exposing 24 million of these users, many of which are young men, to this prediction market that has ruined so many people's lives over the years. The platform that made buying stocks feel like a mobile game is now adding actual betting into the mix now. So where does this leave us now? Does it matter what we call it? No, seriously. If something walks, talks, barks, and quacks like gambling, does calling it a prediction market or a forecasting tool actually change anything? The mechanics matter a lot more than just the label. You're still trading on these binary outcomes with swift resolutions. You also have to ask yourself who's actually benefiting from this. You have to follow the money. Robinhood makes money from trading volume. Every contract someone buys, the platform gets a cut or benefits from it. They don't make as much money from their users making smart long-term decisions on their investments. The more frequent your trades are, the more money these platforms are able to make off of you. Is there potentially a conflict of interest there? And what's the real social cost here as well? We know gambling is a real problem. We know it destroys lives. We know mobile gambling increases addiction rates. If these prediction markets start becoming standard on other mainstream investing platforms around the world, what percentage of those users are going to start developing serious problems? Are we actually even solving an investing problem by adding these prediction markets to these apps? As I mentioned earlier, prediction market advocates say that we need these platforms to aggregate information and produce better forecasts. But do we really need to? Are we really solving problems that exist in today's society by allowing people to bet on election results? What gap in the market is this even filling? Regardless of anyone's general stance, these prediction markets are here to stay, whether we want them to or not. If you decide to use these platforms, go in with clear eyes and understand that this is a zero-sum game that you are playing. Your win is going to be someone else's loss. Make sure to set limits too. Be honest with whether you're having fun or making actual investments. In the big picture, it's going to be really important to see what plays out from having this incorporation between investing platforms and prediction markets. Regulators are still figuring this out. Companies themselves are still figuring out how to deal with this. And at the bare minimum, all of us are going to be exploring this new landscape together. If you found this video helpful, do me a favor and drop a like. Thank you for watching.